Well, welcome everybody back to the Rice Report, our conversation series. Today, we're going to be focusing, really drilling down on economics. And I am joined today by Robert Infra. If you guys aren't following this guy on Twitter, you absolutely should. Some of the smartest economists that I know personally in this world are paying attention to him. He is brilliant on the facts, stats, and figures. And I think that what we're going to work through today is figuring out what's coming next. It's very easy to pinpoint where we are. Very simple. There's plenty of data out there. Most of that data is configured in a format that politicians favor. So we try to look through the nonsense and the BS that's out there in government data. Looking at consumer data is super important. I'm one of the only guys who continually talks about consumer data. But Robert has some great insight. And Robert, we are so happy you're here with us today. Thank you for joining us.
Thank you. Yeah, good to be here.
And you've been at this for a few years now. So this is something you didn't expect to have people following you. We just talked about that off camera. So tell us about your journey to getting here from your life to macroeconomic. Many guys out there say, they point at Robert and they say, this is my quant. And because you have such great data. So how'd you get here? How'd you get into this?
Thank you. I got into Bitcoin in 2009 or 2010. Unfortunately, I don't have any of those Bitcoin I bought back then. But I got into Bitcoin. I loved the decentralized nature of it, the permissionless nature of it, the cypherpunk vibes. And that kind of got me into Bitcoin. And I was kind of in and out, didn't really know what I had. And I was only 18, 19 years old. So, you can't expect a macroeconomic genius at 18. And so, I was just kind of in and out, but that was my introduction to markets. And then I would say around 2019, 2020, I started getting interested in markets, just kind of buying stocks here and there and trying to kind of dabble. But then when 2020 happened and kind of all the money printing and chaos and all that kind of stuff, got me a lot more interested in markets. Unfortunately, I kind of expressed that through the meme stock stuff, went down that whole road, unfortunately, but it was kind of what introduced me to markets. And then, honestly, the kind of macroeconomic side came from kind of the inflation post the big, print during 2020, 2021. Post that, I was working this day job and, pretty high level, and was kept asking for kind of, a raise because gas was like $8.50 a gallon here in LA. And inflation was really, really bad. And so, the owner was, struggling too with rising costs, and basically kind of like wasn't really able, to help me very much. And so I said, okay, well, markets are by then I had kind of had enough experience with that to understand there's money to be made here. And if I take it seriously, I have the right obsessive kind of mindset, that when I really decide to do something, I do it pretty hardcore. And so, I decided, what better way to make extra money than really diving deep into all this, and also kind of trying to figure out why me and my friends who had all kind of attained director level position, pretty high up, we had climbed the ladder, why we were all feeling so depressed and hopeless and that kind of thing. So it got me really interested. And the more that I started learning about kind of the economic side, because I didn't have any formal education with economics, the more that I kind of started to engage with that content, the more interested I got. And because it kind of works well where there's the artistic side, I would argue, of markets, where it's kind of this like living, breathing organism, millions of participants all over the world interacting in this kind of weird biological organism. But then on the other side, it's very quantitative and very black and white. And so for the way my brain works, that seemed to click. And so, I mean, I would say with Bitcoin, unfortunately, that period of time from 2009-ish up until 2020, I was just kind of in and out, unfortunately.
That's what created your depression, Robert. That's why.
That's what I was going to say. If I had not been in and out, I wouldn't have been so depressed in 2021.
So the categorical factors to what drove you here are fascinating. So anger, right? Like, why are you displeased? I have this high level position. Why can't I get by? This is a very common theme in America. This is what fiat currencies and Ponzi based systems actually create, is a lot of demoralization of a society that'll take any new solution. The other side of that is we're seeing a revolution of people. There are the academic economists, which are kind of the old school. They're the ones who trust everything from the government and all these numbers, and they're very analytical and good. I have plenty of them on my show. They're nice people. We haven't really had a blowout argument yet, but we've definitely had disagreements. And I think that there's a new wave of people who are realizing this system is not in our favor, and I need to figure out what the system is so that I can navigate around it and find a better place for me, for my family, for my success and my future. So your pathway is there. It's all change comes from a revolution of people who are disenfranchised from a system that want to realize what it is and make changes. So thank you for being here. I love the journey. Super important. Let's dig into the numbers, man. Where are we right now? What are you seeing in the current economy? And by the time we're done with this interview, we're going to go through, are we going to print or not? And I think that this is a big debate because they're saying we're easing back on quantitative tightening right now. We're not quantitative easing. We're easing back on tightening, which is easing. The word easing is in the statement they've made. So, so where are we at right now? What are the things that are keeping you up at night? What are the things that get you excited right now in the economy?
Yeah. So, I mean, we had a pretty tremendous pullback. And honestly, this rally, I mean, it's up again today. S&P's up again today. This rally is really sharp. And something about it, I'm just not buying per se. So like I just did a video about this, but the consumer, in my opinion, I've kind of, to your point about speaking, maybe contrary to some of the mainstream data sources, just from my own anecdotal experience, the people I know, the real people I know, have been struggling for over a year and a half, 2 years, and kind of gradually weakening. And I just did this video that kind of dived into the consumer and their debt. So I think the consumer, the average American, now we know the top 10% account for over half of spending, and consumer spending is a huge portion of GDP. But that bottom 90% is certainly tapped out. They've certainly been hurting more and more, kind of this gradual sort of degradation. And then the top 10%, it basically comes down to them. So the question becomes, where do we think their spending is headed? I would say that, from here, like in the broader economy, I tend to, the framework, and I've had this framework for 6 or 9 months, is that the tariffs would not be very inflationary.
Agreed.
Um, and I actually think that they could be disinflationary. And that was premised on looking at the first term and the tariffs during the first term, and the currency offset. So the dollar yuan had moved, I think, 12 or 13%, just from the moment Trump started to talk about tariffs through the implementation. It was about 12 or 13%. And you overlay CPI, and inflation was never even above 2%.
Right.
So in the Fed's eyes, inflation was too low. And so that was kind of, now we haven't really gotten that dollar strength this time around. But I still tend to think that, when it comes to what Americans need, um, if Americans needed cheap Alibaba stuff to survive, then I could see it being inflationary. But the two biggest items that people need on a day-to-day basis is energy and gasoline, and then food. And now it's not 100% sourced from within America, but like seafood, I think, is a big import. But in general, America has enough energy and we have enough food. So you remove those two factors and you kind of get down to a lot more discretionary items. And I think that the consumer, has been so degraded. The bottom 90 have been so kind of degraded over the past few years, that they'll get to a point where they just say no. I'm not buying it. And this is, again, anecdotal. The people I know are kind of at a point where they work their way to the top, and they're just disenchanted, and like you said, and they're talking about, I'm going to move to Japan. One of them's going to move to Japan. One of them's going to move to Mexico. One of them's going to sell everything they own, buy a van, and just be a vagabond. So like that's the sentiment, just drop out.
I admire that, by the way. I
Me
admire the
too.
people who do
Yeah.
that. Oh
I
God, I
don't
love
think
that.
I yeah, I don't think I could, but I agree with you that it's admirable. And like I understand where they're coming from. They're getting to a point, I think, especially young people, where they're just that there will come a point where they just say no more. Like
Yeah.
this is just untenable. And so I kind of think that yeah, there will be a lot more demand destruction with the tariffs. And looking at GDP has softened. Inflation has softened. So, I look at oil, which is down 10, 11, 12% since Liberation
That's
Day,
fair.
and that
Yeah.
sends a pretty big warning. Like, I don't think oil would be down 10 or 11% if we were about to, have significant inflation. And then you also look at like break evens, and break evens are flat to even down, the 5 and 10 year inflation break evens since Liberation Day. Bond yields are up kind of marginally with this kind of bear steepening, which I think is more fiscal related.
Mhm.
And with the tax bill that's being debated right now. So yeah, that I don't short of a big print, short of kind of fiscal impulse or stimulus through something like QE, or on the fiscal side, yeah, I just don't see, because inflation's a monetary phenomenon. So, if someone's income is not rising, we kind of established they're pretty tapped out. If their income is not rising, where is all this inflationary spending going to come from?
Right.
And so that's kind of generally how I see the tariffs. Now, I would say too, and I have been saying that the tariffs alone were never going to address the current account deficit. Um, it could be used as a tool in that direction, but the real issue here is the dollar. And so again, where we are since Liberation Day, you look at the dollar and it's down 2.5% or
Yeah.
so since Liberation Day. So I think
Rebounding in the last week. It's moving
a
back up.
bit, yeah,
Yeah.
a bit, but in general, it's down about I think 2 or 2.5%. So I think the dollar will be key. They need a accurate, fairly fundamentally valued dollar in order to truly balance, address the current account deficit and move in the direction of balancing trade. The dollar is kind of grossly overvalued due to the structure of the system and this capital account surplus that we've the policies that both parties have ran. So I suspect that kind of the next phase will be to address that dollar side, the currency side. And if on Bloomberg, I think it was like 2 or 3 days ago, Bloomberg ran a story that the trade talks with South Korea, currency came up in those talks. And so I think that the likelihood of some kind of, people, including me, we're calling it the Mar-a-Lago Accord, something along those lines. I mean, you had Scott Bessent. The reason I started talking about the Mar-a-Lago Accord was I listened to Bessent's speech at the Manhattan Institute. I want to say it was like July of last year. And he openly said like 2 or 3 times, multiple times, he said, there is going to be a monetary reordering. And
Mhm.
even went as far as saying, and I want to be part of it. And then you have Myron's work, chairman of the Council of Economic Advisors. His paper that he put out in November was really kind of what turbocharged this thesis to start to develop in my head. And so, yeah, I think that'll be kind of the next big roadblock. Although I would say, I think this tax bill, uh, I think the bond market potentially could maybe, I mean, we've seen yields rise, um, you know, over 30 basis points in the past 2 weeks. So very quietly, but it's possible the tax bill is the next big thing. It kind of, I think, just depends on the bond vigilantes, but yeah, that's kind of generally how I see things now with a Mar-a-Lago Accord or addressing the dollar and the currency issues. This has, a tremendous impact on things like gold and Bitcoin. Um, the debt for not just America, but basically every developed market needs to be devalued in real terms. Pretty much the entire developed world is over indebted.
Yeah.
And
What are we
and
at
so
right now? It's globally a 311%
Yeah,
debt to GDP ratio globally, and it's
I think
massive.
so. Yeah, I think that's correct.
Basically, the world at large would never be able to get a mortgage because their
Yeah.
debt to income ratio is way out of whack.
Yeah. Yeah, it's pretty incredible. And you look at this tax bill and it's kind of only making things worse. The deficit for fiscal year 25 is actually higher than the deficit for fiscal year 24.
Yeah.
So, there there are a lot of kind of bubbling issues. Now, I'm not saying there will be a failed auction and, you know, catastrophe, but it does kind of feel like this tax bill might be a Liz Truss kind of thing,
Mhm.
potentially. But I think the tax and the fiscal side with Congress and the tax bill, I think you have that, which could be the next big kind of event or phase in markets. And then I think after that, the currency needs to be addressed. And if you believe, that all the Trump talk, all the administration talk about make America great again, reindustrialize, real wage gains for the bottom 90%, all that kind of stuff. If you think it's all just talk and he's not serious, then the likelihood for a Mar-a-Lago Accord is probably pretty low. But I tend to think that they're fairly serious
Me
about this
too.
kind of.
I think they're extremely serious about it. It's just something we've
Yeah,
never seen before.
not in
And I
my
think that's
lifetime.
part of
Yeah,
the yeah, I'm older, so not in my lifetime either. But we haven't seen this in literally over 130 years. No sort of dramatic reform of the economic system. It's just been a band-aid system, especially since
yeah,
2008. It's just been band-aid on a bullet hole for years and years.
yeah,
So I agree with you there. Now, one thing that's interesting about the Mar-a-Lago Accord, if you're not familiar with this, it relates back to the Plaza Accord, which is an original meeting that was designed to increase international trade because the United States' major import is the dollar. Our export is the dollar. That's really our power throughout the world. So in order to have reserve currency status to maintain it, we have to weaken our currency so that other currencies get strengthened, so that import export becomes more profitable globally. We also have to make sure that we're at that time offshoring manufacturing, giving that away. So we traded manufacturing for reserve status. I think there will be something in the middle of no reserve and global reserve. I think that Bitcoin is emerging as the center point. I don't want to call it a global reserve currency because that's not what it is, but a global transaction hub where local currencies convert to Bitcoin, transact cross border, and I'm sure there will be other currencies used in that space. But I think Bitcoin is the major winner. Of course, local currencies will be used like the yuan, the ruble. These will all be used for trade. But keep going on this path because it's important to understand that as you look at the macro perspective, our dollar has to weaken in order to strengthen ties for tariffs to actually be profitable. And the tariff structure right now is working out perfectly. The UK negotiation completely flipped the tables on tariffs. We don't really import anything from the UK. So we're charging them more now than we're paying because they import a lot more from us than we do from them. This is
yep,
the way global trade balance should happen. And I just did a presentation, so you're flowing right where I am. So yesterday I did an investor presentation labeled "Tariffs, Taxes, and Turbulence: The Road to 2025," and we're going to see those in coordination. So you said if you believe in what Trump's doing, I believe what he's doing is he's creating a tariff revenue which is not going to exceed taxation. It's just not going to. There's not enough money there to exceed the amount of money they steal from us every year. But I think what he's going to do is put a dent in that to open up negotiations in Congress to lower taxes for citizens and put that burden on foreign entities, which should have always been the case, which is going to lead to tremendous turbulence in the market, which is actually where you make your fortunes.
yeah,
So people need to understand that volatility is vitality. That's
yeah,
an opportunity to make money. So continue on with this because I think getting into you're probably the only other guy I talk to that actually covers consumer debt. Everything is national debt. Everything is this global debt to GDP ratio. When about 60% of our overall market is directly tied to consumer spending, like
yep,
60% of money is tied to. And again, you mentioned a great stat. By the way, I'm going to prove you right. So, Leading Report just put out an issuance saying that wholesale pricing in the United States is down a half a percentage point. That is the first drop in 20 years in wholesale pricing with tariffs in place.
yeah,
So the deflationary action is actually happening right now to onshore manufacturing, which is not going to, I don't believe, lead to a lot of blue collar jobs. It's going to lead to a lot of robotics and AI infrastructure because we do have a declining economic society. I don't put a lot into what Larry Fink says, but Larry Fink gave a speech at the World Economic Forum not long ago saying that declining populations will actually profit more from AI manufacturing, robotic manufacturing. That puts America in a prime position to be a big player in the profit game. And we have to be, because the more money we make on tariffs, the less money we pay in taxes. That is the trade-off that has to take place. Are you seeing that too? Are you seeing that process? I mean, most people aren't, but I'm seeing it.
So we got the Treasury budget data a couple days ago, and it was, the tariff revenue was lower than Trump had claimed, which, people need to take him seriously, but not literally, in my opinion. It was lower than I think Trump had claimed or wanted, but it was still high enough that if you annualize that tariff revenue for that month, annualized out is about $200 billion. $200 billion is about what the bottom 70% of income earners pay through income tax. So on that run rate,
That's huge.
it would be enough to eliminate the income tax for the bottom 70. And when it comes to reshoring, reindustrializing, the dollar, like we basically, set up this system where we ship all of the good paying jobs. I mean, it used to be, one person in a family go to work for the factory or the plant, the steel mill, whatever it was, and it was enough to survive, not just on their own, but to provide for a family and buy a house, car, maybe even two cars.
Two cars, yeah.
They're relatively good paying jobs as you go. And we decided to ship those jobs overseas. And the way that the structure of the system worked, as you mentioned with the reserve currency, is in order to get the dollars that the rest of the world kind of became structurally short. Um, this is the euro dollar and all the dollar denominated debts. The way to get the mechanism to get those dollars to the rest of the world was trade deficit. Then the other side of the coin, which I'm glad more people are finally talking about now, but the other side of a trade deficit or a current account deficit is a capital account surplus. And this is really what kind of opened my eyes, I would say a year and a half ago. And I started overlaying, basically inverting the current account and overlaying it over things like the S&P, the net worth of the top 1%, all sorts of things which seem to indicate this kind of structural bid into financial assets. The trade deficit is about $140 billion per month for last month. So this is a huge bid into, S&P, corporate bonds, U.S. Treasuries, real estate. You can actually overlay the inverted balance of trade. You can overlay that with the kind of affordability, housing affordability, right? You take the median sales price and divide it by the median family income. And outside of that period of time when QE2 and QE3 injected, almost $2 trillion, it's basically the same line. It's a very, very tight correlation. So basically, this capital account surplus has been making the top 1% extremely wealthy. Anyone who owns financial assets, and we know that the top 10% own 93% of U.S. equities. So, for certain towns, right, like Manhattan or DC, certain classes of people, this kind of globalized system worked really well. But the downside of it was, real wages have been declining for at least 20 years, if not longer, depending on how you look at it. I've used many different metrics: personal income over M2, personal
Mhm.
income over gold, average hourly wage over gold, average hourly wage over GDP, over M2. All of these kind of metrics, though, paint the same story, which is the average American's been getting absolutely crushed for at least 2 decades. And we see this with the skyrocketing deaths of despair, which are now higher even than the Great Depression. This is alcohol, drug overdose, and suicide combined. Suicide rate hasn't been this high since the Great Depression. Antidepressant prescriptions have 13x'd just in the past 20 years alone, right? The societal KPIs for America have been screaming, these bright red flashing lights. And I do think that Trump and this administration, kind of to your point, sees those lights. Those lights have been ignored by both parties for many years, but I think you're right that they see this as an issue, and people like Besson and Myron are smart enough to understand that this is all happening because of the structure of the system. and this ever strengthening currency leading to an ever increasing trade deficit, leading to ever increasing capital account surplus, leading to ever increasing wealth for the top 1% at the expense generally of the bottom 90. So yeah, I think they understand those dynamics. I think they understand the structure. And, on the one hand, I am hopeful, like what I would wish to happen is certainly that they do kind of really attack this. But even just when I try to be objective uh, and look at things the way they are objectively, even then, I still agree with you that I think that they're serious about addressing some of these things.
Yeah, that was one of the first things I heard you say online was the correlation of the top 1% and the trade deficit, which
Yeah.
if you look at the top 1%, all of our largest exporters in this world are multi-billion dollar monopolies. And
Yep.
we haven't had antitrust laws enforced in this country in 40 years. So we have allowed monopolies to build. When monopolies build, you have huge swaths of markets that are owned by a small amount of people. So our entire economy from a wealth perspective is completely centralized.
Yep.
Just looking at it from an entrepreneur's perspective, you're kind of like, I never took entrepreneurship in school. I think it's actually a ridiculous thing to have somebody who's never started a business teaching you how to start a business.
Yeah.
But when I got out and I started mentoring kids, I would hear the advice that they were kids. If you're under 25, sorry, I'm old now, so I call under 25 a kid, young people. When I started mentoring them in business, that I would ask them what advice they were getting from other people, and it was repetitive. It was always kind of this American model. It's not what you know, it's who you know. And that expresses that power structure
Yeah.
at the top, right? So if you want to be $1 billion company, you got to get into a club, and that's not really a fair market. It's just the way things are. But that correlation of the 1% and the trade deficit, I think, is something no one else talks about, number one. And I think it's something that every one of my listeners will be very interested to understand. So even a tariff implementation is an attack on the wealth at the top.
Yep.
And that's why they hate him.
A weak dollar policy, right? Like, so we talk about weak, strong dollar. Okay. So a strong dollar is kind of what we've ran this king dollar policy. Both parties have done it for several decades. And you create this dollar flywheel where the ever strengthening dollar, it means that the trade deficit is ever increasing, so more jobs are being shipped overseas, we're importing more. U.S. exports are further and further uncompetitive, so all those high-paying manufacturing jobs in the U.S. go away. But a strong dollar does kind of perpetuate or allow for this dollar flywheel effect, where the dollar becomes it becomes a carry trade, right? So these foreigners invest in the S&P, farmland, real estate, corporate bonds, treasury bonds, whatever it is, dollar denominated assets, which causes this kind of unnatural strength in the dollar. But on the other side, we have, these markets that basically go up and to the right all time. So they're making money both ways. And so when that flywheel starts to spin in reverse, the net international investment position for the US, this is the difference between what we own of the rest of the world's assets and what they own of our assets, is about 90% of GDP, negative
Mm.
90% of GDP. And so we've basically sold out our country, including our debt, to the rest of the world. And what did we get in return? We got declining real wages and cheap plastic trinkets from Alibaba. Um, the top 10% or top 1%, or anyone who owns financial assets, yeah, that chart was pretty eye opening. You overlay the top net worth of the top 1% as a share of GDP, and it is basically a direct fit with the inverted trade deficit. And this is true for corporate profits. To your point,
Mhm.
a huge amount of our quote unquote economy nowadays is basically just a few companies,
Yep.
huge multinational $1 trillion companies. And corporate profits are also, a very tight correlation with the trade deficit. So they do better, right? Their margins increase. Anyone who holds financial assets gets kind of obscenely rich from this flywheel, right? Where the dollar is kind of used. Our markets are used as the piggy bank for the rest of the world to recycle their surplus into,
Mhm.
and it makes a very small
Great way to
handful
put
of
it.
people. It makes a very small handful of people very rich. And meanwhile, the bottom 90%, their real purchasing power of their wages has been declining for decades, depending on how you want to look at that. And so, yeah, I think that to break that, you need a weak dollar. Well, in the short term, a weak dollar would be inflationary because we rely on the rest of the world for so much stuff. Our trade deficit is so crazy. Yeah, a weak dollar would potentially have some short-term inflationary impacts, but weak dollar is actually, in the medium to long term, a good thing for the bottom 90. This is what makes U.S. goods competitive in the rest of the world.
Absolutely.
So to make U.S. goods competitive with a weak dollar or
Great
fairly
for small
valued,
business.
and exactly. And so, then we start to kind of reshore good paying jobs. The American economy becomes net productive. We run this kind of insane twin deficit, and somehow the dollar is strengthened. And that somehow is this kind of flywheel, this reserve status. And so, yeah, I think, when you finally have US goods competitive in the rest of the world, all these kind of good high paying jobs uh, can come back. Real wages can actually increase. It is very bad for financial markets. Populism in general is very bad for the S&P 500. And so, yeah, that's kind of how I'm generally looking at things. Is, in general, in the medium to long term, a weak dollar it would harm the top 1%, harm the wealth,
Mhm.
but be good and benefit the kind of bottom 90, because it would make, I mean, I'm not even arguing for a weak dollar. I'm just saying for a fairly valued dollar.
Correct.
Um,
Yeah, and the 85, the Dixie at the 85, 88 range is very fairly
yeah,
valued.
or even lower. I mean, on a
I
balance
can
of
see it
payments
going to
basis,
65. I've
yeah,
seen that in my charts, yeah.
yeah, yeah, like 60s to 70s is kind of, I mean, yeah. So I think that that's kind of the general framework that I have, and ultimately comes down to a question of, like I said earlier, how much do you believe in the administration? Now, the thing I would say too is that I think that this kind of general thesis will play out not just in this administration. I think that there will be rising populism from the left, because when I was kind of coming of age, it was the left that hated
Mhm.
globalism, that spoke out against NAFTA and China's admission to WTO and all this stuff. I mean, you go, look at the battle for Seattle,
Meanwhile,
right?
they were getting rich doing it. Just I wanna keep you keep
Yeah.
you in check here. So while they were speaking out against it, they were all making a
Well,
tremendous amount of money, being paid to be against it while it was happening.
as the working class was speaking out against it,
Yeah.
the wealthy ones were, yeah. But it was a kind of a core tenet of that side, with as I was growing up in the early 2000s, was anti, and they accurately predicted a lot of the things that we're seeing. So I think that you see them, maybe, some wing of that party start to kind of echo, I guess you could say, some of the Trump sentiments. And so I think that this persists. I think that this kind of populism, around a weaker dollar and a restructuring of the hyper financialized economy. I think all this stuff kind of is independent of party. I think that over the next, I don't know, 5 years or so, we could see both parties kind of in one way or another. I think they'll implement it in different ways, but I think that generally speaking, we could see, I mean, Bernie and AOC were just here, and they drew a crowd of, like, I don't know, 50,000 people. So there's clearly this appetite for, people do not want the, like, neoliberal Biden, Schumer, right, Pelosi thing. People don't want that anymore, especially the younger people, though. I would say that, they like Trump. They like what he had to say.
Mhm.
And we saw young voters swing, pretty hard for him. But I think that, you will also see similar kind of sentiments echoed by the left. And so to try to figure out where we're going, you can look at the S&P 500 divided by gold
Yeah.
during the kind of mid 60s to early 80s, the last time we really had this kind of political climate, social climate, and it was not good. The S&P basically went sideways for 12 years, and in gold terms fell, I think, 40%,
Yeah.
50%, something like that. So yeah, this is inflationary, this is volatile, um, and especially if they start getting into a restructuring of the global system, because not only is our money broken here, right? Debt based money and all the things Bitcoiners know so well, not only is the domestic money broken, but the international money is also broken, global
More
broken
broken,
money.
yeah.
Yeah, we have, this normally. the currency should be able to be a release valve, an equalizing force, right? That, when a currency gets too strong, exports become less competitive, so the country exports less, and they might start to run a deficit. So gold and Bitcoin start flowing out to the rest of the world. They're kind of aggregate economic activity drops, liquidity, all these things. The currency weakens, and eventually currency weakens to a point where all of a sudden their goods are competitive. So they start selling to the rest of the world. And it's just this kind of ever in flux, ever adjusting, equalizing sort of force, but the currencies are broken. Whether it's the dollar, and the overvaluation of the dollar due to the stuff that we've talked about, or, other currencies that are manipulated lower, like the yuan. So I think that, you mix kind of the populist stuff that we were talking about, you mix that with a global monetary reordering. Um, and I think it could be pretty exciting times in the next
And you have a
few years.
multipolar world of fair balanced trade and nationalism returning, pride in products. There's so many different things that come from it. I want to rewind and emphasize a point you made. You talked about us selling out our country over the course of these years. And this is something people hear and don't really understand what that means. I'll give you examples. About 40% of our national parks are owned by foreign countries. National parks. They've sold the land. That's authorized by politicians. The Dallas North Tollway, where I live right now, is owned by a private equity group in Spain. So all the tolls that we pay don't go to Texas, they go to Spain. The city of Chicago sold all of their parking meter revenue to a PE group in the UAE. So every time you pay for a parking meter in Chicago, you're paying somebody in the Middle East. It's actually not going to the city of Chicago. So very stealthy and silent over the past few years. This is exactly what's happened in America. I will express my opinion, and this is a very long-standing opinion. We don't have political parties. We have actors on both sides who play both sides of the fence to lasso the sheep into an area of understanding so they get their way. And this is a big part of, especially as you're young, you believe that there are Republicans and Democrats. Well, both of them have allowed bad things to happen over the course of 100 years, really since the Federal Reserve. They've just allowed really silly, unconstitutional policies to pass. So don't get wrapped up in politicians and following them. I think Trump is different because he didn't start this way. I don't think he really had any interest in being the president. I think he was kind of put into that position to make change. He is a change maker. You cannot deny that. There are certainly things about an administration. If you agree with everything someone does in an administration, you're not critically thinking. So there's always things he does. I would say 98% of what Trump is doing right now is just completely radical from our norm, completely radical. And the signals he's giving to the market. Sorry, this earpiece keeps falling out. As he gives signals to the market, which he does, right? Like he's literally said, buy stocks, and the next day the stocks went up. So you can look at that in two ways. Like it's interesting. The left will call it market manipulation, despite the fact that they've been doing it for 40 years too. They all do the same thing. But the signals we're getting in the market right now, and I just look at basic signals. We have a 4% rise, a suggested 4% rise in the debt ceiling, $4 trillion rise in the debt ceiling. Yeah. So $4 trillion, that's opening up space on the credit card limit to be able to draw more cash. That's a signal for QE. You have inflation rising, but not as fast as they expected. So it was supposed to go to 2.4. It went to 2.3. It's a 0.2% increase. That is also a signal. So inflation is not as bad as we thought. That's a QE signal. We are now at $101 billion per month in national interest payments. That's our interest-only credit card payment to the Federal Reserve. 101 billion. That's $2.3 million per minute. Where every minute that passes, we're paying $2.3 million to a private corporation for printing our money. Then you have the Powell and Trump arguments. Trump wants rates to be lowered. Powell wants to keep them the same. I don't care what anyone says on any platform. Our Federal Reserve is not a financial arm. It is a political arm. And we're seeing the politics play out. When they lowered rates with higher inflation so Biden could potentially be reelected, that was a political move, definitely not Faulkner-ish. That was very much dovish. Then you have Trump saying the stock market's going to go higher. I think he's right. After a period of turbulence, I see that. I think we're going to see a drop for a considerable amount of time because that balance has to take place from the 1% to the 99 again. So as they get punished on tariffs and different avenues of a weakened dollar, that wealth transfers into the bottom half of the economy. When they have capital, they're going to be putting it in the equities markets. That's proven. We are so overweighted in equities on a household basis right now. It's insane. Foreign investment. He's coming back from Qatar and Saudi Arabia with about $2 trillion in foreign investment right now. That's where he's at. He hasn't even gotten on the plane yet. So it could be 3 trillion by the time he gets here. I think that's a backup plan for capital injection into the economy if Powell delays an interest rate drop. But nonetheless, we have all of those signals coming. On top of this, before we get into that, I want to get into the consumer, who no one talks about. We all talk about the government and their problems and all this stuff. Consumer credit card defaults are at an all-time high. Auto loan defaults at an all-time high. First-time home buyer defaults are at an all-time high, which is shocking. Not shocking when you look at the interest rates, but we have a lot of first-time home buyers that were buying houses that are 100% overvalued for 7% interest. So we're looking at these major defaults. Sales are flooding into the marketplace itself from homes. These are people who bought in 2023, 2024, first house they ever bought, went from renting to buying. There's a significant increase. Renting is much cheaper right now than buying. So they went into a higher environment, didn't get the raise like you were talking about, didn't get their raise that they were looking for. Now they can't afford the home, and those houses are going on the market at a discount. And you're seeing, not everywhere, you're seeing that in like Jacksonville, Phoenix, Dallas. Dallas proper, the city is flooded with new sales that are on the marketplace. I think Trump wants to lower the interest rates significantly to make mortgages more affordable to halt that. I mean, our real estate market is a gigantic piece of our economy, huge piece. Yeah. And if we lose that, we lose a lot. But then Cruz has also put these Cruz put in a tax bill to get us back to 100% deduction for real estate investment. These are all things that are happening that people aren't really seeing. All you see is the panic-driven fear mongers on CNBC going, "This is crazy. Why would you tariff anything?" Now we're seeing lower wholesale rates. The consumer economy. Let's get into that, right? One of the things that threw me off on a live I did maybe 3 months ago, as I saw this report saying that retail sales were up 2.5%, which is true. It's not a lie. It's true. Like retail sales are up, but nobody, like you do all the time, you cross-reference things. You're saying, I overlay this, I overlay that. When you start doing comparative analysis and you look at a rise in retail sales, but then you look at a rise in credit card debt, credit card default, a rise in inventory, reported inventory. So inventories didn't go down, but retail sales went up along with credit card debt. This isn't really hard to see, right? That we're not selling as many things, we're charging more for them, and people are paying for them in credit cards. How sustainable is that to an economy from a consumer view all the way up to a government view?
Yeah, debt fueled consumption. So, and this gets back to kind of what we were speaking about earlier. That's basically America's problem, is that we overconsume. If you look at us, if you look at our GDP, and as a share, denominated by gross federal debt or by M2, we are getting declining returns. So on each dollar of debt that we issue, we are getting declining returns. On each dollar we print via M2, we are getting declining returns, and we have for decades. This is not a new phenomenon. And then you add in the twin deficit, and basically the country is not productive on a net basis. People use this analogy of, oh, I go to the grocery store, spend $8,000 a year on groceries, so I have an $8,000 trade deficit with the grocery store. I don't see a problem with that. Well, to really flesh that out, okay, so now imagine you make no income and you have an $8,000 trade deficit with the grocery store. Actually, now let's assume you're losing money and you're paying money out on debt and bills in addition to all the spending, right? So that's the twin deficit, and whether it's kind of real GDP, GDP denominated by debt or by M2. Or it's this kind of structural twin deficit. Like America is just we are not producing enough value. We are consuming far more value than we are producing. If this was an individual, this would be a huge problem. If this was a corporation, this would be a huge problem. The only reason it has not been a huge problem is going back to the dollar, is this exorbitant privilege with the dollar. So I think that in general, what we will see, not just in America, I think that China has been speaking openly about trying to transition away from this kind of overcapacity, subsidized export dumping, right? And more towards domestic consumption. The CCP themselves have been talking about this for years as a desire. And then you have in America, right? We are trying to kind of consume less or at least produce more. And so I think that, this is all kind of part of the Mar-a-Lago Accord, but basically, the to answer the question, the issue with the consumer and the issue with the structure of the economy, just kind of in general, is that everything is debt based. Everything
Yeah.
is debt fueled. And so, yeah, what I did is in this last kind of consumer debt video that I did, I took the personal interest payments and divided by the average hourly wage. And so this gives you a number that basically tells you the number of hours of work to service debts, that the number of hours Americans need to work in order to pay debt. And it's 4 or 5x since the 70s. And so, as a share of wages, right? And so when you look at some of the data that I examined in that video, you can see that even though the federal funds rate is 1/4 or 1/5 what it was in the early 80s, the number of hours of work that
Hmm.
Americans must work to pay debts has increased 4x. Um, and so you look at the federal funds rate at 4.3, and it's really not that much higher than the 90s, 2000s, but yet these personal interest payments are three or four times higher, right? So you have this divergence where the rate hikes and the higher bond yields have really hurt the consumer.
Yeah.
Now, if you own a home, you have benefited. You basically have kind of um, you know, you have that asset. But if you're younger, you've really been hurt because, yeah, all the most of this consumption, just socially speaking, we consume way too much.
Yeah.
This is just kind of mathematical reality, and don't produce enough value. And so I think that not only America will start to address this, but and like I think Americans know this. They might not have all the data and be able to recite all this granular detail, but I think like in general, people just kind of know
Hmm.
that there's too much debt and too much kind of consumption and this consumerist sort of philosophy. I think people, especially younger people, are starting to in general, kind of waking up to that. And then, yeah, then you add other countries like China who they desperately need to move towards more domestic consumption. You get this kind of global picture where we could see not just a kind of American restructuring, and but a global one. And so, yeah, the average American, like, what we really need is real wage gains, real
Yeah.
purchasing power terms, wage gains. And that comes from better paying jobs. And better paying jobs only come back with a weaker dollar. Now, that'll hurt the top 1%. And every night that I watch CNN to get a pulse on kind of that particular segment of society, they are just like conniption fits. Like
They're
every night,
furious.
about a 5-10% decline in the S&P, right? About it's truly mind blowing how upset the power centers and the elite and the wealthy. They are truly upset, and so, yeah, they will continue to be upset.
Yeah.
But I think that these things need to happen, and I think most Americans kind of know intuitively that some of these things need to happen. But yeah, the consumer is not strong, right? Like I think one of the best memes that I've seen in the past year is born too late to buy a house, born too early to
Yeah.
explore space, born just in time to finance my Domino's pizza with Klarna.
Yeah.
Um, you get to a point where it's just absurd, the
Yeah.
level of kind of debt. And so, yeah, I think that manifests as kind of and we're starting to see this with younger people, especially. I forget the phrase that they used, but it's basically like a buying strike,
Hmm.
where the Wall Street Journal's covered this phenomenon where young people are just like, I'm not spending money anymore. I'm cutting spending. I'm trying to save more, because if you are consuming more value than you produce, kind of by definition, wealth is flowing out of your country.
Yeah.
Now, the top 1% gets a lot of that back through financial assets, that the capital account surplus, but in general, just broadly speaking. And so, yeah, so I think that that's how it manifests, especially with younger people, where they just say no. Like, I'm not doing, whether it's dropping out, buying a van and, doing the vagabond thing, or moving to Japan, or like my friends, or whether it's just, I'm not buying that anymore. Like, I'm
Well, it's an
not
internal
taking another.
change. Yeah,
Yeah.
I mean, like I talk to young people all the time, and a 25-year-old guy that I see at church and I see around town. One of the things that he mentioned to me, he's like, "I'm making my own coffee," and I said, "That's great." Some of the wealthiest people I know have a coffee pot, right? They don't go spend $12 at Starbucks for a coffee. They actually make their own for like 80 cents for a pot of coffee. I don't drink coffee, but a pot of coffee can't be more than a couple bucks and some water. And they make it the way they like it. They make it at home. I love seeing that change because the numbers are staggering. We're $17.8 trillion in mortgage debt in America, $1.72 trillion in credit card debt. Now take $1.7 trillion and multiply it by 24.5%. That's the amount of interest only payments Americans are making. So what is that? $500 billion, $500 billion a year goes to Visa and MasterCard.
Personal interest payments are about $530 billion. Yep.
It's an insane amount of money. And those are personal interest payments. Those aren't even principal payments.
Yeah.
So that debt remains while people are just literally flushing $500 billion down the tubes. So what happens in an environment where taxations are cut? The cost of importation is a little more expensive to a corporation, but the net to the consumer is 0.5% break in wholesale pricing. You start to see this really big growth once again for the first time in 65 years of the middle class. The middle class is actually what makes a country free. It's not the ones at top. They never want freedom because it impedes on their income. And the lower tier of society wants freedom, but doesn't have the means to get there. So this opening of the gaps and like financially, I've been behind everything Trump's doing. I think that tariffs should have been done 50 years ago. If nothing else, balance them out. You want to make things fair, make things fair. Say everything import export is 5% on both sides, and we have a 5% flat federal income tax. I don't care if you make $1 billion or $5, you're paying 5%. No one would complain. Surplus would be an inevitability at some stage, 10, 12 years down the road. But this entire thing leads into people looking for escape rafts. Like we've just described in a domestic and global economy that I don't care who anyone is or how smart they think they are. There is no solution. There is no solution to $37 trillion in debt at this current point in history. And you can run it through AI models. There is a 5% chance an AI model, if we make changes on tariffs and lower income tax, which actually hurts the ability to pay off that debt. It actually doesn't pay off the debt. It just pays the IRS. But if we actually run that model, you see a 5% chance over a 100-year period that America could possibly pay off 37 trillion in debt. That's if we add no further debt. We are going to 41 trillion in the next 12 months. That's already been announced. A debt ceiling has never been announced and approved and not maximized. No one's ever got their credit limit increase and didn't max out the credit card immediately. So we're going to 41 trillion. So that 5% chance in 100 years goes down to 2.5% with every $1 trillion that comes about. It gets cut in half. So we are in this unsustainable model right now. We're also seeing bank lending tightening, which is a big thing. So in an economy where you need to borrow money to succeed, now we're looking at 20% of all banks are tightening on large and mid-sized business, like 16% on small and mid. Small and mid-sized businesses need loans more than anyone, by the way. Their working capital with a dollar status right now is really bad. But then we have the energy infrastructure stuff that's happening. That's going to take years. Like there's no switch you can flip and become energy independent. We need refineries all over the country. We have very few. One just blew up in Northern California about a week ago. So refined petroleum products will be very expensive for a while. It's just a fact of matter when shortages occur. So you have all these things that are going there. People are flooding. Well, we're flooding to gold. So gold just did a huge run up. I've been a gold bug for years, so I'm pretty happy about that. Became a Bitcoiner a few years ago because I put in the time, put in the work, and you start to see that this is the escape hatch. It's not your equity style home run hitter anymore. I think that was the early years of Bitcoin, but I think Bitcoin is a steady 30 to 60% CAGR. It's a saving. I look at it as a savings vehicle. I don't even look at it as an investment. It's where I store money because I don't want to be censored and I don't want to be confiscated. And with the things I talk about on some of my shows, I'm probably right in the middle of that list to be confiscated or censored. So I keep that stuff very, very, very clean on Bitcoin. I'm very bullish on Bitcoin. We're on Bitcoin Twitter Spaces all the time. Where are you seeing? Gold has seen a rundown from 34.5, 34.50 down to about 31 today. I think what we're starting to see is a lot of folks that are taking profits in gold, not the country, but like the system. We're not buying Bitcoin yet, but I think traders are. I think traders are looking at that run up in gold and going, we got 100% in basically 2 years in a 7% per year investment. Let's put it into something different. Now, the world is talking about Bitcoin for the first time favorably. Where do you see Bitcoin fitting in this economy? Because I see it really as kind of the off ramp. And the head of the ECB has said we can't let people get on the off ramp.
Yeah.
Right? She's literally said that about Bitcoin because it is decentralized. But where do you see gold and Bitcoin going in the next, call it like 6 months? We really can't look further than that. The next 6 months.
Yeah, 6 months. I mean, I'm very bullish on both. I've been very bullish on both since 22, 23. I think that, this, like you mentioned, this pullback in gold is kind of short term. I think that generally speaking, over the next couple of years, it'll continue to move higher because, to your point about the debt and deficits, these issues are starting to kind of accelerate, right, in the wrong direction. And so I think that that's very bullish for gold and Bitcoin. I think that the key issue with gold and Bitcoin, I would put Bitcoin in this phase, is that these surplus countries need a store of value. So when you run a surplus with the rest of the world, you accumulate all sorts of currencies, that you are not spending, you are not consuming with that wealth, and you need something to store that wealth in. And historically, this is what people call the global reserve asset. And historically, this has been the treasury bond. But I think with the administration being who they are, and the recognition, accurate recognition, of how this capital account surplus is causing so many issues. I mean, we saw in February Trump, it was an executive order that basically explicitly targeted Chinese capital and told it to go home.
Yep.
You have, Stephen Myron's work in that paper in November. He wrote an entire paper on how to kind of target foreign holdings of things like treasuries through user tax or this forget the acronym, but there is a statute or a law that exempted interest from being interest on treasuries from being taxed by the U.S. A reversal of that kind of thing. And so, yeah, I think you couple that with what we did with Russian FX reserves, with Russian U.S. treasuries that Russia held, and I think you start to paint a picture where the rest of the world, all these surplus countries, need a store of value that is sovereign, that is independent from any kind of centralized control. And gold and Bitcoin are these kind of perfect vehicles for that. They are both bearer instruments, and I think that gold has certainly played a role, certainly becoming that, serving that purpose over the past maybe 18 months or so. But I think Bitcoin starts to also, around the margins, I think, I don't know, 5-10% within the next couple years of surpluses might get put. I think the UAE and the Emirate countries are much more open to storing some in Bitcoin. I think it'll probably start there. But around the margins, on a $2 trillion asset class, it could be meaningful within a couple of years. And yeah, I think that generally speaking, the direction is kind of in that multipolar, independent, sovereign sort of direction. And now, when you are moving in that direction, currencies start to become fairly valued again, or fundamentally valued, based on capital flows, interest rate differentials, balance of payments, this kind of thing. And this is exactly what this administration would need to reindustrialize, right? One way you get a weaker dollar is to basically uh, somewhat give up this kind of artificial bid into US dollar assets, and you start disincentivizing that, whether that be treasuries or, I mean, there's like $9 trillion of foreign held equity, US equity, that's currency unhedged. I think in total, foreign holdings of US equity is 16 or 17 trillion dollars.
Yeah.
And so I think, around the margins, we're going to see that kind of thing where, and as gold and Bitcoin kind of rise up, to fill this void, or to serve this purpose, currencies start to become much more fundamentally valued, which is a good thing. Now, again, it's not so good for the top 1% and kind of all the things we were talking about, but it is good in general, kind of medium to long term. It is good for the average American.
If it's not good for them, it's good. We'll
Yeah.
rephrase that. We'll keep it simple. If it's not good for the top 1%, it's good for you.
Yeah.
And that's a good thing to look at. Yeah, I think we're starting to see this stuff with trade between, Russia and China, and many people have reported on it. I don't know if we've looked on chain for that, to be fair, but that's been reported there. For international trade, there's no better vehicle. It's a completely neutral asset. So there's no corporation, no government behind it. We are getting into that, though. We have the Trump family launching a SPAC for a large mining operation here, a PPA, a power purchase agreement operation, which will be a thin margin mining operation, kind of like Mara and some of the other big public companies. But we're watching that happen. We're watching large sovereigns discussing with their foot in the door through ETFs. We're watching that stuff. And the UAE has $600 million already, or
Yeah.
600 million in Bitcoin already. I expect that to exceed like 10 to 12 billion in the coming years, relatively quickly. I think his meeting in Saudi Arabia this week was very telling, just how excited they were to have somebody in there to allow prosperity in the region. And there's certainly concerns about what's happening in Syria. I won't get into geopolitics or global stuff, but there is certainly an appetite out there for a globally neutral asset that appreciates with, I don't tout this, but like you're looking at 44% CAGR since 2020, which is like, find that anywhere else. A consistent, steady base. Excuse me. But when we look at the gold and Bitcoin markets that are being comparative now, we're watching the merge between the two, where a lot of I talk to a lot of gold people because I've been in gold for a long time, and I would tell you that 8 out of 10, at least 8 out of 10 right now, have decent Bitcoin holdings. They're looking at it as a hedge. So gold will be my steady run. Bitcoin is kind of my hyper explosive asset that I could have. But gold has had a hyper explosive run for a while. It's the first time in I think in history that the S&P was beat by gold for a period of exactly 1 year. I think it's the first time that's ever happened, isn't it? Or it actually can't be the first time. It's the first time in 30 years or so.
Yeah. In the 80s, I think it was. But I mean, the other way to put talking about gold, the other way to think about it, and this is one thing that I kind of do with a lot of things, as I've been talking about denominating all these different metrics by different things, is like you can take a 60% run up in gold, in the price of gold, and you can take that to mean what most people would think, which is, wow, this asset went up by 65%.
Right.
The first thing I think when I see that, and what I always point out, is that the dollar was just devalued by 60%.
Yep.
Each dollar buys you that much less of real scarce assets. And that, to your point, that sort of move in such a short time should also be, kind of screaming, throwing up red flags to
Oh yeah.
policymakers. You don't really hear any of them talking about it, but that's the other way to think about that move in gold, is that, your wages didn't go up by that much, right? So you kind of got poorer. And this is, I look at Bitcoin in a similar way. As Bitcoin goes up, if my wages are not rising at that 44% CAGR, it is getting harder for me to accumulate and acquire this scarce asset.
Mm-hmm.
And so there's kind of two sides to the coin. Uh, we use the dollar as a denominator for everything. And so many people, especially in like the TradFi world, have kind of like built everything around this dollar denomination. Uh, and what I've realized, and what I try to point out and illustrate, is that the denominator is broken. Like, you look at housing, for example. You take the average sales price of a single family home in America, and if you're a young person, you definitely know that has just gone parabolic, and greatly outpaced your wages. But I interestingly, if you take that sales price, that average or median sales price, and divide it by gold, housing has actually never been cheaper. It
That's
is
right.
not. It is not that housing is getting more expensive or more valuable. a house is still just a house. If anything, they're getting kind of cheaper. And we're talking the difference between like 600 ounces of gold versus 100
Hmm.
from peak to trough to where we are now. That is a huge, cheapening or decline. And so yeah, the dollar is the denominator is what's broken.
Yeah.
And I think this also applies to the S&P 500 and most financial assets, but specifically, for me and my friends, housing is a huge issue. And I always pointed out that look, denominated in gold, housing has actually gotten substantially cheaper.
Yeah.
And so the issue, what that illustrates, people go, well, what's the point of that? What that illustrates is it's a way to swap out the denominator. If you believe that the US dollar denominator, which we use denominate everything in, if you believe that it is broken, we'll start swapping it out.
Yeah.
And gold is a perfect kind of neutral measuring stick. And I also do it with like M2 and GDP and other things. But yeah, I think that I think that people are starting to wake up to this, even if they can't articulate it.
Sure.
All the work that I've done around this kind of general thesis, the denominator is just broken, has gotten like extraordinary support from just normal people, not economics nerds or market people or Bitcoiners, but just normal people. And so I think that there's kind of a recognition that, something about our money is broken. And it's true, like I said, not just here
Or
domestically,
everything.
but yeah,
Something or
globally.
everything. Yeah.
Yeah, yeah,
Yeah, and Bitcoin's the same. Like, if I would have bought my house in Bitcoin in 2020, it would have cost me 46 Bitcoin. Today, it's like 14.
yeah,
So scarce assets, valuable assets, they are a reflection of a debasing currency, and it's something that I think you're right. Most people I talk to now actually at least grasp that, or they say it before I do in conversation, which never happened before. No one ever thought that way before. So let's look at the end of the year as we wind down the interview today, which has been great, man. Thank you for joining me today. This has been
yeah.
a lot
Thank
of
you.
fun. I love geeking out on the economy. It's like one of my favorite things. But let's get into, like one of the things I wrote a process. I wrote this 4 months ago when or 3 months ago when the tariff conversation came out, and you started hearing Trump's an idiot. He's going to crash the economy. None of this stuff is true. Obviously, not an idiot, which is the worst claim on the guy. He's exceptionally intelligent. But we started seeing that this is a haphazard plan, wasn't planned out. Obviously, it was. He's been talking about tariffs for 35 years. You can trace it back to an interview 35 years ago. But I started looking at the multipolar world really at a Freedom Fest in 2022 in Memphis, Tennessee. I interviewed a bunch of Austrian economists and just phenomenal conversations. And everyone was talking about the multipolar world 3 years ago. And a multipolar world, to get there from a unipolar world where the US is pretty much king on top of the mountain, dictating terms to the rest of the world, which no one wants. We don't even want that anymore. It's just not a reflection of fair economies. Number one, to get to a multipolar world, you have to standardize international trade in a globalized system. You have to do that. It has to be standardized. So that's where tariffs come in, creating standard fixed practices. So I know what it costs. You know what it costs. Now we can do business again. You've got to debase the currency here in order to strengthen currencies around the globe so they can build themselves up to be self-sufficient without foreign interference. Then you have to strengthen trade to be able to create better products cheaper and export and import more effective. And then you've got to infuse capital. Like, those 4 steps are what I see of how each nation needs to kind of prepare for this multipolar world. And for those of you who don't know what multipolar means, it means instead of the United States running the world, which is what happens right now. And it's nice when you're the king, but we're obviously seeing right now that the king is stealing from the peasants. This has been happening for a better part of 50 years now, pretty consistently since the 70s. Very documentable, very provable. But you're going to have to infuse capital. That's why foreign investment in the United States is very important. Uh, I wish our own corporations were putting trillions of dollars into our system, but our own corporations need to be broken up. The corporations by name are by definition by law monopolies, and they need to be broken up, and they need to be run in different ways. But the infused capital, that's a big part of it. So that's another way of weakening the currency here, strengthening it around the globe, and a way of getting more dollars into the global south, which obviously if you're looking at the stablecoin bill and thinking this is a big thing for crypto, it's not. I mean, it is. It's a huge gateway into crypto and a huge gateway into Bitcoin. But the real purpose of a stablecoin bill is to create more buyers for U.S. debt. That is really the actual political insight to this, because our auctions are in the 65, 67% bought range by foreign entities. The rest is bought by the feds. We need to pump those. Those are rookie numbers. We need to pump those up. So the stable coins will be a vacuum for U.S. treasuries. That is the purpose. We need new buyers of our treasuries, and these banks and corporations that are launching stable coins will be those buyers. But they will also get U.S. dollars all throughout the world in places they can't get it right now. So while the multipolar world is balancing itself out, because remember, a lot of these nations have never operated on their own. Never. They've never done it. It's all been foreign capital running these countries, their banking system, their political systems. So as they learn how to live independently in a globalized economy, you're going to have to infuse capital. And I think that we're at that point in Q3, end of Q3, beginning of Q4. I think that's when we see, like Larry Lepard talks about the big print. And I love the arguments over Larry. And Larry's a bold guy, and he's made bold statements, and he's been wrong in the past. And that's what bold people happens to bold people, is they make things, make claims that don't come true. They also make a lot of claims that do come true. Predictions of the future, no one knows it. I'm very biblical, and in the book of James it says, do not go from this town to that and boast about tomorrow and how much money you'll make. You're just a mist on earth. Just live in God's time. But people who make claims are going to be right. They're going to be wrong. I've read Larry's book. It's actually extremely well written. Loved it. Read it on vacation. And I think he's right. I think at the end of the year, we are going to see a big print. And that's why the $4 trillion debt ceiling was raised in preparation for that print. Number one, I know you see that too. We've talked about that. I think you're a believer in the QE cycle. What comes with that? Where should people be? Where are you going to have your capital placed? Where are you putting your bets for that happening? Whether it happens or not, where are you going to that? Because let's be honest, the 30-year is going to hit 5 to 5.25 at some point. The 30-year note is going to hit 5 to 5.25. It's going to be a disaster. Printing money is the only way out.
It was just at 497
Yeah.
yesterday. So yeah, I think that yields, the way I see it kind of playing out is that yields will continue to rise, and the curve will continue to steepen, and term premia will continue to expand, until eventually rates get to a level that is just unsustainable. I mean, we have the 10-year basically back to where it was when Trump was kind of forced to do the 90-day pause. It's back there already. The 30-year was higher yesterday. Than it was at that point. So I think eventually, the long end especially will continue to rise. Rates will continue to rise until eventually they get to a point where stuff starts to break. Just to remind people, when all those banks blew up in 2023, the problem was we were talking about the Treasury as the global reserve asset. The Treasury is also the collateral. It is the collateral for the entire financial system. Everything is levered off of the U.S. Treasury. So when the bond yield goes up, that what that means is the value of the actual collateral, the value of the actual bond is going down. So all these banks that bought, 10 years at 40 bips, and then rates then the 10-year rate went to 4.5. They were, because of convexity, the value of that bond plummeted. I mean, you can just look at this with TLT, or TLT divided by gold, or TLT divided by SPX. And yeah, like the long-term bond has been kind of already on this path, you could call it. And so I think that path continues until eventually it gets to a point where, look, there is no other way out. We know that because of the previous administration shifting so much issuance to the short end, in bills, we know there's this extraordinary amount of debt to basically roll over and refinance, in the next 12 months. I do agree with you that stable coins, more than likely, the real purpose behind them is to create demand for U.S. Treasury bills. And so I think eventually, rates kind of just get to a point, and I don't know where that point is. I don't think anyone really knows. Some people have been saying 4.6, 4.7 on the 10-year. I'm not sure. But in general, I think rates will continue to move higher just due to these debt and deficit concerns, and as well as kind of the things we were talking about prior with the capital account surplus, these foreign kind of holdings of dollar-based assets, and possible attacks on those taxes, that sort of thing, until eventually rates get to a point where they just can't afford it. And the value, not only is the value of the collateral plummeting as rates move higher for the banks, but you also have, the financing costs and the debt service costs for the government rising with the rates. And so, yeah, eventually that all of that kind of gets to a point where they just can't, the banks can't survive, and the government can't afford the debt service cost at those rates. And I think it's pretty close. The other thing I would say is that I think that we're in this environment, and I've been saying this for like a year or a year and a half. Jeffrey Goonlock the other day after the Fed meeting literally sounded like me, things I had said a year ago. And I was like, okay, if someone as smart as Goonlock is repeating, my framework, okay, maybe I'm not so crazy. But I had been saying, that in the next contraction, in the next growth scare, in the next recession, rates might fall the first couple days, the first week,
Sure.
but then they will move sharply higher and the curve will steepen unlike anything we've ever really seen. And I still I still believe that. So the other side is that, we do, so maybe the tariffs start to slow growth. Maybe growth is just slowing kind of already. I would argue growth's been kind of slowing for the past year,
Sure.
just very, very marginally. But whatever the cause, growth starts to contract. Well, in a recession, receipts fall, right? Government revenue falls and expenditures go up due to, unemployment benefits, automatic stabilizers. So you get a widening of the deficit. By my math, by my very basic estimation, the deficit would reach about $4 trillion in a recession. That is, that sounds really bad until you realize in a recession, kind of by definition, GDP is also falling. So
Correct.
it's not just the 4 trillion nominal deficit. You get to a point where you're talking 15, 16, 17, 18% of GDP, the deficit as a share of
Mm.
GDP. And yeah, once you get to that point, it is the big print, like for sure. There's really no other way to describe a 16% budget deficit as a share of GDP. So, I don't know which path it takes, right? Like, I don't know if it's growth and a contraction, a
That's not even
recession,
including
or
unfunded liabilities, which are in the hundreds of trillions of dollars. Like we never talk about the unfunded liabilities ever.
yeah, yeah, yeah.
Just the
So
national debt.
it could take kind of different forms. It could be yields rise and continue to rise, maybe because of this tax bill. Bond market doesn't like this tax bill, right? Or it could be that we get a real slowdown in growth, and some of this very basic math, with widening of the deficit. Some of that math starts to become kind of recognized by the bond market, and either of those paths, in my opinion, would result in significant stimulus. And I don't think it would be necessarily by cutting rates. I think they probably will cut rates in that circumstance. But like, I think today, if they were to cut rates, I think the long end would move higher.
Yeah, I do
And
too.
so the Fed is kind of trapped. But the one thing we do know would kind of work would be balance sheet expansion. So QE. They might call it something different. They might have some fancy acronym for some new program or whatever.
Oh,
But
sure.
but
Rebrand it.
basically, yeah, balance sheet expansion. And we can see, looking back, every successive crisis, the intervention has needed to be far greater. And so, COVID was what, 5 trillion or so. This time around could
Six.
very well
Yeah,
be
we
10,
hit 6 trillion during COVID. $6 trillion was printed during COVID.
And it's important to point out. So in 2008, and this is covered in Too Big to Fail, the movie Too
Hmm.
Big to Fail, which is kind of the backside of behind the scenes of 2008. And they were saying, how do we value this? They were talking about the bailout and going to Congress to ask for money for a bailout. They were like, how do we value what is the total number of all these toxic assets? No one really knew. But someone kind of eventually came up with an estimate of about $1 trillion. And they went, are you crazy? We can't ask $1 trillion for TARP. And so, just to put it in perspective, like $1 trillion not too long ago was an incomprehensible sum of money. And now we're adding 2 trillion every year, run about a $2 trillion deficit every year. We spend, to your point about interest, we spend over 1 trillion, close to like 1.2, $1.3 trillion a year
Yeah,
on interest.
1.22. 1.22 is what we're on path for right now.
Yeah. So eventually this all gets to a point where, higher rates in that sort of environment where mandatory spending, the big four, interest, defense, Social Security, Medicare, is already over 100% of tax receipts. Mandatory spending is already over 100% of government revenue. Interest is over 20% of tax receipts, although tax receipts did bump up last month. But in general, right, these trends are not sustainable. And so eventually I think that, we get, and it's not hyperinflation, right? It's not, in my opinion, it's not the 50% month over month inflation, in my opinion.
Yeah,
I think
that's not going to happen here.
yeah,
No.
I do not fall into that camp. I don't subscribe to the cat food under the bridge sort of argument. I think it'll be significant, but I
The
think
cat
that
food under the bridge has to accompany some sort of massive geopolitical event, war,
yeah,
terrorist event. I mean,
yeah,
there's to get. I mean, and I've been in that camp, right? And years ago, when you start looking at the strength of the U.S. economy as a whole compared to the rest of the world, like we're just not facing the same type of problems there, unless something horrifically violent happens here and grids go down or something like that. But there's so many different solutions for that. I think with Trump in office, we're past that time. I think it's a little scary. I think when Biden in office, that was a legitimate fear.
yeah,
With a weak leader in place, attacking this country is a possibility. You're never going to win. No one's ever going to win a war in this country. You've got to get through 2 coastlines and then mountaintops and 450 million guns. Like it's like that kind of fear. Regionally, you might have something happen, but yeah, I don't see us plummeting into like Joe says, the cat food under the bridge.
yeah,
I think into the cannibalism camp. I mean, if you're in that place, it's not really a possibility in America. A depression is like that is a absolute possibility, not a probability, but a possibility. But we crawled out of that one pretty quickly with no technology and no alternative currencies and no anything else. Because I think the thing you said that rang true right now is collateral asset. So, as the US Treasury has been known as the collateral asset of the world, especially our banking system, I don't think there's any coincidence that banks are now open to buy and hold Bitcoin. I think Bitcoin becomes the new collateral asset, and I think it will be the largest asset used in reinsurance, which most people don't understand. But I think it's a huge reinsurance product already being used there. I've had banks contact us about how does Bitcoin work to explain it to them. I think it is a new collateral asset. I think the bit bond model is a pathway out of what we're in economically. But everyone should know, and I think this is paramount for people's sanity. There is no quick fix for what we're in, guys. There is no snap the fingers, we make a change here. It's so intertwined, and you can look at the consumer for that. If we lower rates, it does ease the pressure of consumer debt, right? It does do that. It will lower your credit card rates. It will lower your credit card payments. It will lower your ability to your payments on mortgages and cars. But wages have to coincide with that, and wages aren't rising that quickly. The government side, you have all these different traps that are in place, right? The bond yields will impact the equities markets. It's a huge cat and mouse game that we're going to have to let this administration cook. We're going to have to let them have their time. I think the pathway we're on is somewhat seeable, but the beautiful thing about genius plans is that you can't really see them until they're over. And we're watching the little increments happen here, and stick with it. Take care of yourself and your family. That is the most important thing you can do. I love Robert. I love hearing that young people are opening their eyes to these things right now, because you can't understand the purpose or the need for Bitcoin unless you understand the system at large. And if you understand how intertwined this web is, and this web is completely designed to keep you where you are, like upward mobility is a financial term. They use it in social hierarchy, but upward mobility when you're working has to do with your ability to earn more money, and we simply can't. We're not there right now. This country is not there right now. We're going to have stagnant wages for probably another year. I think 2026, 27 are going to be incredible years based on what we're seeing today, but we don't know. Don't worry about the cat food under the bridge. You're also not going to get a free Lambo tomorrow morning. Those two things are not happening in the near future. So what advice would you give everyone out there? Just all the stuff all this economic data we talk about online all the time. I've given the same recommendation for the last 2 years, and if you follow 3 years, and if you followed it, you're doing really well. I've said gold, silver, raw land, private oil and gas investments with significant tax discounts and monthly distributions, and Bitcoin. And that mix of 5 things. And of course, there's the, there's the people say, put 100% in Bitcoin or put 100% in gold. I don't, those 5 things make sense to me. And they make sense to me from an investment perspective because they're all traditionally conservative investments with a lot of upside if they work out. Where would you give advice to everybody out there? And it's not financial advice, but what asset classes do you think will outperform the market as a whole in the next, say, 12 months with all the things we've talked about?
Yeah, so I think if I'm right, foreign currencies, we've already started to see this with like the Swissy, the Swiss franc, the yen. I called out a long on the yen at 155. I think it's still got significant room just on a purchasing power parity basis. So these foreign currencies for sure. We talked a lot about the dollar and the overvaluation of it. The flip side of that is that some of these currencies are severely undervalued. And so,
Good call.
the yen, I personally wouldn't do that for anything other than a trade, right? That was a
Yeah, of
trade,
course.
uh, uh, given their debt dynamics. But yeah, like the Swissy seems like this is what I'm kind of recommending to my family. Swissy, if you want to be in stocks, if you really feel like you have to be in stocks, I think that on a relative value basis, emerging market and foreign indexes could now this trade kind of got crowded recently. The time to really get in was January, February when I started talking about that. That would have been a perfect entry. But in general, depending on your time horizon, I think foreign currencies versus US, I look at the 60s into the early 80s, and Chem Carson also kind of mentions this particular analog, this framework, and the S&P went sideways.
Mhm.
And in gold terms, it went down. And so I would definitely not be in long-term bonds, because long-term bonds mathematically must lose value on a
Yeah,
real basis. That is the way that we deal with the debt, is that the bonds lose value on a real basis. Now, short-term bonds, right, like a money market fund, I think that that's relatively safe, if as kind of a stopgap or an intermediate step if you're not sure where to put something. I think money markets are always okay, especially at 4.3% today. But yeah, gold and Bitcoin. I think that those would be the two kind of primary. I would say
agreed.
50-50 if you want to do if you believe in this debt and deficit issue, if you believe in this big print, if you believe in the perfect expression of that is long gold, long Bitcoin. Because when you are long gold and long Bitcoin, the other way to phrase that is you are short purchasing power of dollars.
That's right.
And I think, look, people hate on gold. I've liked gold since 2022, 2023. I think it's still good for what it is. I think Bitcoin does everything gold does better.
Agreed. Yeah.
It's more divisible, it's more portable, it's more verifiable, it's even more scarce. So I think Bitcoin is just kind of a objectively better version of gold, but I still like gold. And gold still serves a purpose. And
I look
yeah,
at
like it,
gold as my bond portfolio and Bitcoin
yeah,
as my equity portfolio anymore.
high
That's literally
beta.
the way I look at them.
Yeah,
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 exactly.
yeah. Like your Bitcoin is your kind of high beta Nasdaq tech stock kind of thing. So yeah, and if you need to be in stocks, I would say foreign indexes will probably outperform the S&P and Nasdaq. Now, look, we've started to see just in the past week or so, we started to see a total return to the like just buy Nvidia, just buy Mag 7, like that insanity has seemingly started to return. So I hope I'm not eating my words in the ear, but I do generally believe that in general, those kind of momentum things will underperform. It just because, either you believe Trump is more of the same, you believe it's just more status quo, in which case just buy Mag 7, just
Yeah.
if you believe it's all talk and it's just more of the same, then just go, lever up and buy Mag 7. But, personally, I do think, like you said, we're in agreement that they are pretty serious about reforming some of these structural issues. And yeah, during kind of populist, inflationary, volatile periods, you want to be in scarce assets. and sovereign assets, and that's gold and Bitcoin. And definitely not bonds. Like one of my favorite charts is TLT over gold, TLT over Bitcoin, TLT over S&P, and it is just down. Like for the past like 10 years, it is just down relentlessly. So yeah,
I'm going to throw one more in there.
Long bonds are bad.
I look for assets to hold. Like I'm an asset guy. It's the oldest trick in the book is you find the best asset you can possibly find. You buy as much of it as you can. You borrow against it. You create liquidity from it, and you die. Like that's the oldest model in the world. And as long as borrowing is a thing, that's going to be a thing. One thing I recommended 18 months ago, or excuse me, almost 2 years ago, those are my 5 assets to purchase and hold. Like if I think all 5 of those, I think your recommendations of foreign currency, I'm not thinking in. Those are trades to me. I look at there's a way to scalp those and create an arbitrage and lever them. The other thing is, in markets like this, you just described turbulence and volatility. I've been recommending the VIX, which most people can't buy the VIX because they don't have an account there. The UVIX, which is a 2x levered long fund. I have made a fortune on this in the past 2 years. When the yen carry trade unwound, I literally made enough to buy my kid a new car. When the tariff announcement was made, I could probably go out and buy an investment property. I just bought more Bitcoin. Realistically, that's what I did. But if you sit on it, right now the VIX just took the largest decline in something like 26 years. So it's back down. The VIX is right around 1820 something this morning, something like that.
Yeah.
UVIX at 28. If you want to play in the market and you want to try to scalp some cash, I think sitting on the UVIX until the next thing happens, because when you're dealing with trade wars, guess what? Next things happen all the time. That is to be expected. Turbulence and volatility is to be expected until a new system is implemented. So play the volatility. When it's low, buy it, sit on it. When it pops up, sell it, dump it, cash in, buy back later. These are really simple strategies to help people.
Yeah, I for my year ahead kind of forecast and predictions, I talked about tariffs and trade and gold and all these things we've been talking about, the debt and bonds. But what I said for my kind of main prediction is that it's going to be very volatile. And sure enough, that has so far at least proven correct. So yeah, I think I would just encourage people to understand kind of volatility, how it's calculated. Maybe do a little bit of my nerd out, right? Get familiar with like a decay and stuff to make sure. But yeah, like volatility in these periods of time, in populist periods of time, especially when you're going under global monetary reordering and global trade reordering, volatility will be elevated, and there will continue, in my opinion, for the next 12, 18 months, continue to be volatility for sure.
It'll be your friend if you use it right too.
Yeah.
It'll be your friend.
Yeah.
Well, Robert, this has been amazing, man. I know I've gotten you like a half an hour over the time we allotted, so I appreciate that. Appreciate the conversation. Any last bit of advice, and let us know how everybody can follow you online. You got your own YouTube channel now, so we certainly want people subscribing to that. Let us know how we can find you out there.
Yeah, thank you. So YouTube, I just started it like a month or 2 ago. It's Infranomics, INFRA nomics. And yeah, I'm just trying my best. It's new to me, YouTube and videos and the whole thing is kind of new, but I'm trying to hopefully educate, or at least start conversations, start people thinking about some of these concepts we've talked about, and explained in simple English, that everyone can understand. Because when I was learning, right, when I was spending 30, 40, 50,000 hours learning about all this stuff, there wasn't someone who would just talk about it and explain it in simple English. And so I'd hear a concept or a term, have to go run over here and, do an hour of research and get familiar with that concept or whatever, and then go back to the, podcast or whatever it was. So like, for me, it was really difficult to kind of get to the point that I am now. So my whole goal with both my Twitter and my YouTube is to hopefully reduce the amount of that sort of effort that it takes to understand some of these things. So yeah, Infranomics on YouTube, and I just try to kind of be educational and helpful there. And then on Twitter, it's just INFRAA _. I have a blue check. There's a lot of scammers now that have
Oh yeah, welcome to the club.
Impersonated me. Yeah, so just make sure it has a blue check. But yeah, those are the two main places to find me.
Well, keep up with them. The stuff he posts, his videos are fantastic. Thank you for making those. And I'm in the same. I'm not I don't get paid to podcast. I do this because I'm trying to help people understand. the world around us. And this is what it's going to take. It's going to take heavy lifting from a lot of people. And there's plenty of, Bitcoin podcasts and specific podcasts. There aren't very many good economic podcasts that are designed for that. I would recommend yours. I would recommend James Lavish. I think he's an incredible teacher. He really explains things. I try to do the same myself, but I certainly have strengths and weaknesses like everyone else. But look for people who are trying to help you understand things and not show off how smart they are. Yeah. That's really the big difference in the space, because the more that we understand together as a community, the more ideas we come up with, the more that we can actually fight against this 1% who owns our trade deficit and create economic equality through America. So, Robert, thank you so much for being here. We look forward to having you on here again in a couple months. We'll catch up, see if your predictions took place, see how you're doing, catch up with you. And just God bless you. God bless your family. I hope this the remainder of the day is great for you. And I really hope your predictions come out, because they're very in line with mine. And I think everyone out here will do great.
Sounds good. Thank you.
You got it. Thanks, Robert. Have a great one.